Okay, ladies and gentlemen, welcome to Macro Ace with your host Tony, going through the Bank of Canada prep. Just giving you guys a couple of minutes. I know a couple of the commenters on YouTube, so they were like a couple of minutes just to kind of jump onto the stream. They did miss out the beginning bit, so we'll give it about 2-3 minutes, and then we'll go right into it. As always, there's a lot to kind of cover with sentiment-wise. And then also looking at market deviations and how much the currency pairs have moved. But we'll, as I said, a couple more minutes, and then we'll get right into it. All right, so let's make a start. Hopefully everyone can hear me clearly and also can see the screen clearly. So the Bank of Canada rate decision. Today it is expected from the markets and economists to see a 50 base point hike to 1.5% from the prior of 1%. And also alongside that, we get the Bank of Canada rate statement as well. But let's go through in a bit more detail about what it is and how it affects the markets and also the sentiment surrounding the Bank of Canada at the moment. So where is the economy at the moment? So inflation rate at the highest since 1991 at 6.8%. We have GDP quarter-on-quarter annualized rate, which came in yesterday at 3.1% versus the prior of 6.7%. Then the last employment change data that we have from Canada showed 15,000 jobs were added in March versus 72.5 in the prior month. The average hourly earnings year on year was lower as well, 3.4% with a prior of 3.7%. And the unemployment rate came in lower, 5.2% versus the prior of 5.3%. Retail sales was also slightly down as well by 0.1% at 0%. And then the PPI year on year at 16.4% versus the prior of 18.5%. And then the raw material price index month on month also came in lower at -2% versus 11.8%. So just to kind of gauge where the economy is at the moment, how inflationary pressures are doing as well. That's one thing we've got to just understand, bear in mind that for a lot of central banks, inflation is the key focus, particularly for the Bank of England, which is their main, which is their aim to control and keep as low as they can. Whereas in the US, you have their mandate, which is maximum employment and also keeping inflation at a stable level as well at their 2% goal. And the ECB, more or less, inflation is their main priority to try and keep down. Of course, that being skyrocketing yesterday, or at another record high, 8.1%. So inflation is the key worry, also for the Bank of Canada, but there is a slight focus on employment too. So going ahead then, so if we're looking at the previous Bank of Canada rate decision, so we'd seen that the last rate decision we had, which was the biggest rate hike in 20 years, or the first time in 20 years that we had seen a half-point hike from the Bank of Canada. Inflation could become entrenched again, plays into the hand of central banks or the Bank of Canada taking quicker action and stronger action to try and rein that in. Quantitative tightening is to begin or began April 25th. So what that means is there's no more purchases of government bonds. What they're looking to do instead is to let those government bonds that they've bought into just to roll off and end. They haven't talked about actively selling those bonds that they've purchased from the government, but I think that's one thing to kind of look out for with the Bank of Canada rate statement that we do get alongside with the rate decision, is if they do switch to saying, actually, we may decide to start actively selling those bonds that we have rather than letting them roll off towards their end date by themselves. But on top of that as well, when we're looking at growth-wise, what they were expecting, a growth of 4.2% this year and 3.2% next year. Of course, we had the annualized quarter-on-quarter data that was much worse than expected if we're comparing it to the prior figure, 3.2%. So more or less, the economy, it looks to be that there's a bit of a lag in the Bank of Canada's point of view of where the economy is headed. If we're considering that, of course, this was all said April 13th, compared to what we're currently seeing now. But on top of that, they also said they see inflation averaging about 6% in the first half of the year, but they see it declining to 2.5% or 2.5% in the second half of 2023, and then returning to their 2% target in 2024. Of course, inflation at the moment well above the target, as said, at 6.8% for the year-on-year rate. So there's a lot of anticipation and markets trying to price in these rate hikes or more of these rate hikes, potentially 50 basis point rate hikes coming in the future. And what they also in regards to the neutral rate then, so this is where in the Federal Reserve, they've also talked about the neutral rate where interest rates would more or less be paused at before they take any further decision whether to hike rates further if need be. So the Bank of Canada raised their forecast for the neutral rate to 2.5% from 2.25%. What you've got to take that as is that, as said earlier, more tightening is needed to try and rein in inflation. In its simplest way, that's how you should take that comment there. And when we look at the deviations and how the markets reacted to these comments, again, not only is the rate decision in itself important, but also the statement. We'll go through that when we look at the deviations later on. Remember, if you are subscribed to the Macro Ace mailing list, you would have received the document of the deviations, so you can see the history of how the different currency pairs had reacted to the past releases from the Bank of Canada, and also the other release that we have later on this week with the EIA inventories, and then Friday with non-farm payrolls. So again, if you're subscribed to the main list, you're able to see that beforehand. We'll put up a link here in the chat so you can sign up to that and stay up to date with it. But again, something you would have seen and give you more time to prep before any economic release that we do. Okay, so going ahead then, so Bank of Canada views. So we don't really get a lot from the Bank of Canada itself, from their members, but when we do get comments, a lot of the time it can be repeated rhetoric about inflation and where the economy might be headed, but sometimes we can get little snippets or more of a confirmation of what markets are anticipating as well. So we had Bank of Canada's Deputy Governor Gravel who said that they're raising rates gradually, and a 50 basis point rise is a big move for a central bank. So just highlighting that we're in this current environment where inflation has skyrocketed and more or less got out of control enough for a central bank to take drastic action. So that's just one comment that was highlighted by that we highlighted from Gravel. The other factor as well, the other headline from Gravel in regards to the Canadian dollar, saying the main factor in the recent Canadian dollar weakness is, despite higher commodity prices, it's likely the strength of the US dollar. So he's talking about the Federal Reserve tightening their monetary policy, and also you've also got the Ukraine conflict that has also seen an inflow into the dollar as well, seeing it as a safe haven away from geopolitical events, and that cash is king. So that's what Gravel cited as the reason why there was some Canadian dollar weakness. If you did watch the webinar as well that I did last week, I would have gone into a bit more detail, and well, actually a lot of detail. It was about 2 hours. Then I went into detail about safe haven assets and how they react to different environments and geopolitical events as well. That is on the YouTube link that we have, and I can put that in the chat for you if you want to have a look at that. But then one final thing from Gravel on May 12th, he'd also said is that it is possible that they will have to raise rates above the neutral because some sectors of the economy may be less sensitive to rate increases than in the past. So again, just highlighting that where inflationary pressures are picking up, if we're considering food prices, energy prices, where there's been with CPI reports where they've been highlighted as the biggest drivers of inflation in those reports, those sectors which see a huge amount of appreciation in inflation, those are the areas that they would be focused on to try and curtail or try and dampen inflationary pressures. Then if we're looking at Bank of Canada's Rogers, they said that the Canadian economy has recovered remarkably fast and people are spending more, and business investment and exports are both picking up. So the export wise, you've got to consider that with the Ukraine conflict, there's been a requirement or a pickup in demand for raw materials, particularly for the natural resources such as crude oil and also natural gas. And that's one of the things that's helped the Canadian economy weather the storm of the geopolitical event that we have seen recently and currently ongoing. But also, other than that, seeing that from the COVID restrictions being removed, that people are actually coming back and spending more on services, right? This is when we're looking at GDP figures and we're looking at where people are spending, particularly in the US too, that there's been a move away from goods or spending on goods or the necessary goods and more to services, so luxury services and goods. So again, just highlighting that there's a pickup in consumer spending and that demand is also picking up for other resources too from Canada. Then Macklem, so after the rate decision, he had also said on April 13th that the economy requires high interest rates to moderate domestic demand and keep inflation expectations anchored at their level they're likely to be at 2%. April 27th, he'd also said that the labour market is seeing excess demand, or there is a tight labour market. So what do I mean by tight labour market? If you're unfamiliar with that term, what it means is that when there are a lot of jobs that are being put out in the economy, but there are not enough workers to fill that demand, that's what you call a tight labour market. So when he says there's a period of excess demand in the labour market, that's what it means there. Also, he'd also said on April 27th that the bank may be forced to raise interest rates above neutral. So similarly to what had been said by Gravel as well earlier on, or actually later on in the month of May, and that could be done a little more than 2% or 3%. So again, the neutral rate that they're looking at was from 2.25 to 2.5%. So just highlighting the need for higher interest rates. So with the markets, when we look at the market reactions and where the Canadian dollar is so far, you'll see that a lot of market participants and traders will be pricing in those expected rate hikes to come along in the future. Then the sentiment at the moment. So some economists see 50 base point hikes stopping after September, and the median forecast is where they see the neutral rate at 2.25% after October. Bearing in mind, this, of course, this sentiment creeping in or coming in after the April 13th meeting. So again, markets are expecting, seeing that maybe once we've reached neutral, we might see a pause. But the only thing to highlight is Macklem did say we could go to 2% or 3%. So it doesn't leave too much wiggle room for economists to kind of expect where the rate or the overnight rate could end up. April 13th, so you had BMO. So his BMO's Porter sees 2 half-point hikes in June and July, of course. What we have coming up, and seeing the rate at 2.25% by the year end. Then you have China and COVID easing. So China has been a very has had a very huge effect on the markets. Not as much as it did during the first pandemic wave, but the sentiment that a country going into lockdown, particularly China, where they have a very strong industrial base, that going into lockdown with Shanghai and areas in Beijing depletes, or we had seen a depreciation in the demand for crude oil. Okay, so we had seen that depreciation in crude oil prices, and in turn, if we had seen, when I did compare the Canadian dollar to oil, we've seen a correlation. When oil prices start to rise or pick up, of course, the Canadian economy is based off of exporting natural resources, and about 17% of that is of crude oil. So when crude oil prices appreciate, then we'd also seen an appreciation in the Canadian dollar as well. Although there has been a slight laggard, overall there has been a general appreciation of the Canadian dollar off of the back of the conflict and also the China COVID easing that we've seen recently as well. So China coming out of its lockdown in Shanghai after 2 months, right? So that helped. So on the weekend, or this weekend, we'd seen that news that we'd put out for you on the Financial News website. That had come out, and the oil markets had started to see a rally instead off of that positive news for the oil markets. One thing I do want to compare later on as well to see how the Canadian dollar has fared compared to oil prices as well. But Beijing also easing limitations in some areas also helped WTI, which on Monday was at $117 a barrel, or about 1.82% up on the day. So CAD futures or the Canadian dollar futures was up about 0.5% is what we've seen. So again, highlighting when crude oil prices start to rise off of the China COVID easing and demand comes back, then the Canadian dollar also sees an appreciation as well. Then on May 30th, or a couple of days ago, we had Scotiabank's Osborne, who said that improved risk environment has helped the Canadian dollar. So again, we're talking about the COVID easing in regards to how the oil markets have fared. That's what Osborne is referring to. And also the expected hike from the Bank of Canada has helped the Canadian strength. So I think these are two very obvious bits of sentiment that are weighing on the Canadian dollar at the moment. One, hikes being priced in, and two, the easing of COVID restrictions and a pickup of demand in oil again from China. So those are the two big factors at the moment that are weighing on the Canadian dollar. Then if we're looking at the TSX Energy Index from Toronto. So that was also yesterday. Yesterday it was up about 1.4%, and it was it was rising for the 7th day on pace for the longest winning streak since April. So again, as I said, a lot of businesses provide natural resources, so they have also seen an appreciation in oil, and they've also seen an appreciation in their values as well. Then from CIBC, so yesterday they had mentioned that they think the market is right with an 88% implied odds of another 50 basis point hike on July 13th, but then seeing that the Bank of Canada will be at 2% and won't get 2.78% implied by the OIS market by the year end. So they're also seeing the Bank of Canada would see a pause at some point, but they're not too sure where that level could be. And then from them, they had also said that the large excess in demand in Canada is much more concentrated in one area, particularly housing. So that's most sensitive, of course, to rate hikes and interest rate decisions. Of course, when the rate is raised, that makes your mortgages more expensive to pay back, and of course, vice versa. When rates are cut, then you see the opposite reaction. It's cheaper to pay your mortgage off. And any borrowing that people are looking to do before they try and buy a house, if the rate is more expensive, or if the rate is higher, it becomes more expensive to do that. So that's where I think CIBC is saying that they want to look at when Canada, or the Bank of Canada, talks about the housing market and how that's going to fare in the future with the higher rate hikes as well. So it's one key part of the Canadian economy, according to CIBC and also the Bank of Canada. So that was what they say, is that they say that something to keep an eye out for in its policy statement. So this is what I want to show you then. So crude oil and the Canadian dollar futures, how it's fared, or what is the correlation then? Again, correlation is going to be another financials webinar that I'll be doing later down the line. But just to give you a hint, as there's a bit of the detail that we'll kind of go through and the relevance of it for here. So, of course, more or less so, we've seen since the onset of the Russia-Ukraine conflict, of course, here is where everyone jumped into their safe haven assets and went away from the risk assets. So you'd seen that depreciation in the Canadian dollar represented in blue. But as oil prices, or as speculation grew, okay, key thing is speculation, not actual loss of supply of oil. But as speculation grew that there could be a huge loss of supply in oil, which could drive up oil prices, what we've seen is that the Canadian dollar and WTI crude oil futures had actually seen a decent amount of correlation together. So if we're going from about March 14th, that's where you start to see when the conflict started to escalate even further, and the negotiations had fallen apart. You'd seen a very nice move between the Canadian dollar and crude oil in the same direction. And again, whenever there's been a downturn, more or less you've seen a downturn in the Canadian dollar itself. And here we go, we keep going along. And this is where we kind of saw a little bit of divergence, or a little less correlation happening. And then here again, when you see that crude oil was down, and later on you start to see the Canadian dollar also see a movement towards the downside as well. But what I want to say is, just to clarify, there is a strong correlation between the Canadian dollar and crude oil and how it fares within the market. So just did a quick highlight of the main points of where it's touched, or where there's been a lot of correlation. About 0.87 is the correlation, i.e. when the figure is positive for correlation, it shows there's more of movement in line with each other. And if the figure is negative or sub-zero, then the reaction would, then the market or the assets will move in the opposite direction. But here you can see with a 0.87 a correlation that they're actually moving more or less in line or in tandem with each other. If anyone does have any questions, do feel free to pop it in the chat here, and I can try and go over it for you. Or if there's anything that doesn't make sense, or again, I'll try and go through that and answer that as best as I can. So then, the previous market reaction then is from the Bank of Canada. So just to go through the deviations of what we had seen. So when we had the rate decision on April 13th, the rates came in as expected with a 50 basis point hike to 1%. And so the biggest mover, what we've seen in regards pip wise, we had seen that the GBP CAD had seen about 43.5 pip movement towards the downside. Then it was the Euro CAD, which seen about 37 pips down, and then the dollar CAD. So these were the big three movers in the currency space, and even in the past as well, we'd seen a similar reaction where the euro was the euro and cable and sterling were the biggest movers. So just to kind of reiterate, then I think these will be the key currency pairs that we'll be keeping an eye out for to see if we do get a similar reaction as we had in the past. But that's the current deviation. That's the current deviation and the pip movement there for you to have a look at. Of course, deviation wise, there isn't anything to really look at for the actual figure to them comparing the forecast figure. But if we do have a look at the previous market reaction, then just to go in a bit more detail. So this wasn't a clear cut release. When I say clear cut, I mean there was an initial reaction in the direction as expected, but it didn't really hold that direction for too long. So let's play the video and I'll show you what I mean here. So about 10 seconds before the release, we've got dollar CAD, CAD JPY, Euro CAD on here. Okay, so the rate comes in at 1% as expected. So we had seen, again, Canadian dollars strengthening, but as you'll see, it doesn't last too long on the first candle. If I kind of skip ahead, actually, I'll show the rest of the video. I'll show it as it is. So there we go. So the reaction happened in the direction as expected, but then it quickly erased that Canadian dollar, or quickly erased that gain that it had. Okay, I have to move a little bit more forward. Okay. And then after about a couple of minutes or so, you can see that you're actually seeing a reversal in the markets there of Canadian dollar strength. So just the key thing to highlight then is that when the rate is expected to come in at a certain figure, the markets will price that in. That's what we had with the last two rate decisions, when the markets had priced in the Bank of Canada rate decision, and then the markets just kind of carried on the movement afterwards, or carried on the movement that they had seen prior to the release. So kind of skip ahead a bit more. Okay. So I think the only thing that we're left with now is just to currently take a look at the current market then, what's currently going on with the Canadian dollar. So that's where we are at the moment then. So if we just bring up Euro CAD, there we go. Actually, let me bring up the futures. 6C. Okay, so if we put on a bigger time frame, then get a clear indication of this market pricing in the rate hike. So if we go back a bit further as well, let me go back to April 13th. There we go. Right. So April 13th, there you go. So that was the rate decision there. So you can see that there was a bit of choppiness. So a bit of choppiness on that candle there. Overall, after the rate decision, it did start to move, or it did continue to move higher. And then when the next rate decision, or the expectation for the next rate decision, started to creep into the markets, then we'd seen this movement towards, or as we get closer, as we got closer to the next rate decision, we started to see the market pricing in the rate hike here. Of course, we've got to bear in mind towards the end of April, we had the China COVID lockdowns. So oil, as we had seen previously, had seen that negative effect in the oil markets and also for the Canadian dollar too. So if you're just kind of thinking as to why we'd seen that move towards the downside there. But as the central bank sentiment takes hold again and consumption is returning, or demand is returning for the oil markets, we'd seen that pricing in the markets there on the Canadian dollar. We're looking at the other currencies too. I said GBP CAD was the biggest mover last time. So we're currently 0.5% down at the moment there. Dollar CAD 0.25 down. CAD JPY up about 0.9. Then Euro CAD. Okay, so about 0.29, 0.3 down at the moment. Alrighty. So I've gone through that quite quickly. Got a little bit of time to kind of go through any questions that anyone has. Of course, don't forget you do have the ISM data as well from the US that's going to be released. The reason why I didn't make anything for the ISM release today, I think from the past reaction, we didn't get too much of a movement from the deviation, from good deviation. So usually from an economic standpoint of view, a deviation of about 1, or if you want to say 1% in the figure, can either add 0.3% to GDP or remove by 0.3% to GDP over a year. So from the ISM report, what we had, if I just bring up that deviation there, I did share that too from the mailing list. So this is what we had last time. So from the S&P, we've seen about 32 ticks down. The NASDAQ, we've seen about 183 ticks down. And then after about 10 minutes, so not after 10 minutes, so it's 183 ticks down. And then we've seen about 83 ticks towards the upside. Dollar yen didn't really see too much reaction there too. It's seen about 19 pips down, whereas all the other currency pairs were around 10 pips. So it wasn't really a big mover compared to the other releases that we've been covering. But it did see some reaction in the markets. We're also looking at the bonds as well, also gold. So 2-year bond price had seen about 11 ticks towards the upside, and 30 about 6 ticks up as well. Gold about 14 ticks. So I think the key thing for the markets, and something that I'll go through when we do non-farm payrolls too in a bit more detail, is that inflationary measures are what is the key focus when we're looking at economic releases, and how central banks react to that data when they're looking to raise interest rates, and what they will say in their monetary policy statements when they do come out. So all these other releases, such as where businesses, if they're seeing a pickup in activity, that yes, it is important for the economy, but for traders at the moment, the key thing is inflationary pressures. All All right. So one thing I also wanted to go through, if I bring it back up. Right. So I think the key thing to remember with the reason why then the last rate decision that we had seen a bigger movement compared to the 2nd of March. Okay. So the 2nd of March, we had a 25 basis point hike to 0.5%. And at that point, all right, it's a hike and it was as expected. And we didn't see too much market reaction, or we did see a positive reaction on the Canadian dollar, but it wasn't as strong as the recent one. I think one of the key reasons being is, of course, it's a 50 base point hike that's being done. And then comments that came through from the Bank of Canada, key thing, going back to the neutral rate, seeing that they raised their forecast for the neutral rate to 2.5% from 2.25%. So again, the expectation for tighter monetary policy, more than expected from the statement, had helped the Canadian dollar see that bigger move on the initial candle. Other than that, I think that should cover the basis then for the sentiment, what the release is, and we've got plenty of time. If anyone does have any questions, do let me know whilst I get the screen set up for you. Actually, I think it'll be a good time to kind of go through some of the... So as I said, the mailing list then for Macro Ace. So as said, the deviation, that is something that we provide to our subscribers that you can have a look at in a bit more detail and have a better understanding of how the markets have reacted to certain releases. I'll just put that here in the link there for you. You can have a look at that there for yourselves and sign up to that. So what that will entail then, just to give you an idea of what to expect. So every Sunday is when I would be putting out the expectations for the week ahead and the releases that we'll be covering and going through. And also I'll be including the deviations for the releases that we'll be covering for that week. But I think if you're kind of just jumping onto YouTube and you haven't really subscribed to the financial service or have really played with a live service which provides Squawk and text, then I think it's something that would be remiss for you to not have a trial of it. So what does Financial Juice do then? So the reason why we stand out is that we provide a service 24/5, okay, and you have real-time live voice and text coming through to you about what's going on in the markets and also the geopolitical events that are occurring, what central bankers are saying as well, all in one place. So you've got the voice here and the text feed there, but also you have real-time to the second economic release figures that we put out to the site as well. Okay, so if you're on the light version of Financial Juice, or you're just giving it you're having a little play around with it, the key difference is with the pro version, where you're currently looking at the moment, and the light version. In the pro version, you don't get any delays to the headlines, or the economic releases, or the voice, and you also don't get any adverts playing or appearing in the feed here as well. So it's a key advantage to have. It's what investment banks and the big players use when they're trading in the markets. The main way that the investment banks use a live a service, or they use a live voice and text service, is to manage their risk. Okay, and a lot of times, of course, they have a lot of money to chuck and spend, so it's also used for trading economic releases too. But for a lot of traders, from what I've seen and what's been said in the past, for them, it's been used as a way to manage risk. So if there is something that's going on in the markets where you may have OPEC saying something, maybe it's talking about potential increase in output or giving an exemption or potential exemption to Russia in when providing oil to the world. Those sort of headlines that come through, that if you are just looking at the markets and not looking at a live voice and text feed, you'll be confused, right, as to what's going on. Having a service, okay, is very beneficial for traders to have a look at. So if I was to bring up just a little reaction then of what we'd seen yesterday from the Wall Street Journal, we had a headline yesterday. Let me bring it up on here. Oops. Okay, here we go. So yesterday we had the headline that OPEC members consider exempting Russia from oil production deal, as according to Wall Street Journal citing sources. So that came out at 47 past 1. Headline went out at 47 past 1. And then this was the market reaction. So as you can see, the market's reacting negatively. There were some people on Twitter asking what's going on in the oil markets. We're seeing a movement towards the downside or a sharp movement. What's going on? Whereas if you were listening to a live service or reading the headlines in real time, then you would know why and you'll be able to better manage your risk. So that's one example of why subscribing or having a go with Financial Juice Pro is very, very beneficial for anyone trading the markets, particularly, especially when they're very, very volatile at the moment. Okay. That's one thing that traders, the more knowledge you have as a trader, the better you can prepare yourself for a trade or manage any trades that you have going on at the moment. So 7-day free trial, if I pop that in for you here, or Financial Juice Pro, that is there for you, that link there. Have a little look at that there for yourself. And also one more thing that will be, of course, showing today is we have Tsx. So if I just bring up Tsx, as I said, I was getting my screen prepared. Okay, so as you can see, Tsx here, I've got for today's release that we'll be covering, I've got the dollar CAD open, CAD JPY, GP CAD, and Euro CAD as some of the main movers or the biggest movers of what we'd seen last time. So what does Tsx do? Okay, what it lets you do is it allows you to listen and see the amount of momentum that is in the markets, okay, or certain asset classes, or you're basically listening to order flow. Okay, so imagine you're in the trading pits and the markets are about to open, or there's been a big bit of news that has affected the markets, and you have all the guys and gals start shouting, buy, 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 sell, 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 buy this price, buy this price, sell, sell, sell this price. That is translated into this. At the moment, I don't have the sound on, but the sound, basically when the markets or when an asset class, let's say a majority of the assets are up, or say a certain asset class, what it'll do is it'll give you an audio alert, basically. So when it's up, you will have like a high-pitched sound, and you can edit whatever sound that you want it to make. And when the markets or when an asset is going down or there's downward momentum, then it will make a lower-pitched tick sound or whatever you want to make it. But here, as I said, as we're looking at if I kind of zoom in on the markets, so we can kind of get more of a real-time view of what's going on. Okay, so as you can see, if there's a little bit of buying or selling that's going on with the currencies against the Canadian dollar, or the Canadian dollar against the other currencies, you see that movement starting to creep in and being displayed on Tsx. So there are different levels to tick strike that you can have. So you can have one where it's very sensitive to the market reactions. If it meets the criteria, then tick strike will go off and show you a lot of movement up and down. So it will show you you'll see more of a volatile movement in tick strike. But if you're looking for a big amount of momentum, or let's say a strong amount of selling or buying pressure, then what you can do is you can raise that sensitivity to 15 as the highest level. So only then, when you see a strong amount of momentum coming into the markets or certain asset that you're looking at, whether it be currencies, futures, ETFs, ETNs, crypto, and stocks as well, then only then will it set off and then alert you via voice or visually whether or not it meets criteria, and you start to see that momentum push ahead. So during the COVID pandemic, or at the beginning of the COVID pandemic, tick strike was going nuts because everything you'd seen the initial capitulation of the markets where everything was being sold, right? And then when the Federal Reserve and government started to step in, you start to see that buying momentum that had creeped back in. But during that time period, tick strike was crazy. And again, it's another way for traders to kind of manage their risk. But if you're a scalp trader, you like to trade little bits of momentum here and there, pocket a bit of profit, then it's also perfect for that too. So again, you can, as I said, you can set it to what level of sensitivity you want it to be. But again, 1 being the most sensitive and 15 being the least sensitive. So that is tick strike there. Still got about 13 minutes. I think if anyone has any questions. Oh yes, of course. Got to put the link in for you guys for tick strike too. So there's a 7-day free trial of tick strike that you can try as well. That I've just put the link in the chat there for you. But if you're looking at the Financial Juice website, even if you weren't looking, if you were just looking at what's on here, so on the Financial Juice website you have a limited selection, okay, and the setting is at 6 of sensitivity. Pro version, okay, shows you have a plethora of different assets and a plethora of different, securities or assets that you can jump into. As said, there's crypto as well that we cover, and stocks. There's a load of those that we cover too. More so now than we did at the beginning of the new launch, the fresh launch of tick strike. But again, if you don't want to be limited by how many different securities, asset class or assets you want to look at, then have a go over the 7-day free trial. There are a load of things that you can look at the same time. Alrighty. Not too long to go. About 10 minutes. What? Oh yes, of course. For anyone who wanted to, so trading risk on, risk off is quite key to understand in the markets, and I did make a video on that last week. So I'll also pop in that video for you to be able to have a look at later on after the rate decision. All right, so that's the link I put in there for you to be able to have a look at later on after the rate decision. I think just a couple more things to kind of go through as well. So of course the estimated figure is for a 50 basis point hike to 1.5% from 1%. I think one thing to be kind of aware of is that the range being is that the highest estimate is 1.75% with a low of 1.25%. So there is according to economists, the highest estimate is for a 75 basis point hike. The lowest estimate is a 25 basis point hike. If we do see that the Bank of Canada raises rates by 25 basis points, which would be a big surprise when they've been talking about 50 basis point hike recently in the past as well, since the last rate decision, then one thing that could happen is that, and what we've seen in the past, is that we could see a potential movement towards the downside in the Canadian dollar. With the Bank of England, when rates were raised by rates were raised by 25 basis points, but one member of the Bank of England was looking for no change because of the Ukraine conflict. What had happened was that the pound, sterling, had seen a depreciation in its valuation because there was the unexpected surprise that had occurred where the rate was kept, where one person wanted to keep the rate unchanged. So I think for the Canadian dollar, if we do see a 25 basis point hike, that could be one scenario where we do see a weakening in the Canadian dollar rather than, even though it is a hike, you might see that scenario. Whereas on the flip side, if we do get a 75 basis point hike, again, which will be another surprise from the Bank of Canada, because they haven't talked about a 75 basis point hikes. More so, again, as said, talking about 50 basis point hikes in the future. A 75 basis point hike would really send the Canadian dollar flying. As you know, whenever interest rates are raised, that will also increase the value of the currency as well. Okay, in this tightening cycle that we see. And I think then for the stock market, what could happen and what we've seen in the past when there has been a rate decision is that, such as with the S&P 500, when rates have been raised and you've seen a depreciation in stock prices to a degree. Of course, this is priced in. But if we do get a surprise of a 75 basis point hike, I think the Canadian stock market would could take a big hit from that there. But if we do see 25 basis point hike, we could see, again, we could potentially see a movement towards the upside for the Canadian stock market instead, if the rate isn't hiked by that much. But those are the potential scenarios then. So scenario for today, as we've seen in the previous market reaction, rate hike as expected, not expecting a huge amount of expecting some volatility on the first candle, and we will be looking to the rate statement itself to see if there are any more hawkish comments, or even more hawkish comments than expected from the Bank of Canada in regards to the neutral rate of interest, how the housing market might be affected as well. But I think if we do see more or less a normal Bank of Canada rate statement where we don't see too many big surprises, then I think we'll just get we'll get a flash reaction as we've seen in the past, and then for that to reverse and the markets to kind of price in the next rate hike from the next meeting instead. Okay, let me bring this down here a little bit. It's a little bit better. All right. So not too much movement then from the currency pairs at the moment. About 4 minutes now to the release. Also to note, there isn't a press conference after this. So usually, I think when there has been a press conference following a rate decision, that's when the Bank of Canada would probably need to explain, or there's more of a hawkishness, or let's say dovishness, that needs to be explained in more detail from the Bank of Canada itself. So we don't have that press conference today. So we might not see anything new or drastic from the Bank of Canada itself. So just over a minute to go then. What I'll be doing is, of course, I'll call out the figure for the bank from the Bank of Canada, and then I'll go through some of the headlines that we receive and go into a bit more detail, and then we'll analyze the market reaction afterwards. So 1 minute to go now till the rate decision. Okay, less than 10 seconds. Here we go. So 50 base point hike as expected, 50 base point hike to 1.5%, as said, as expected. Seeing Canadian dollar strengthening there off the back of that release as expected. We'll see how quick the reaction lasts. Oh, dollar CAD seeing a bit more whipsawing compared to the other currency pairs. CAD JPY seeing some nice movement towards the upside there. GBP CAD still didn't see that reversal like we did on the dollar CAD. Okay, CAD JPY. Okay, let's go through some of the rate decisions of the commentary here then. Okay, so just looking at some of the headlines then. So you have inflation will likely moving higher in the near term before beginning to ease. Ukraine war has increased uncertainties, putting further upward pressure on prices for energy and agricultural commodities. So more or less, nothing too drastic then from the Bank of Canada itself with the figures, or with the statement itself. Also, ISM, just of course don't want to miss it out too. ISM came in at much better than expected, by 56.1. So about the housing market, saying that housing market activity is moderating from exceptionally high levels. That's expected coming through with the rate hikes. So we're looking at the market reactions. The dollar CAD isn't really a nice trade compared to the likes of sterling, GP CAD, or Euro CAD, or CAD JPY. So if I bring up another, let's bring it up here. Let's go for some pips. Yeah. Okay. There's about 27.5 pips. I move towards the downside. Let's look at the euro dollar. It's about 21.5 down. JPY. Okay, so CAD JPY had seen the biggest move compared to everyone else on the initial candle. So we've seen about 31.5 pips towards the upside there. We're looking at the dollar CAD, which is a mess. It's about, so it's seen about 17 pips down on that release there. So rate hike came in as expected. Nothing really big or surprising from the Bank of Canada itself. Just talking about also economic activity too. So Q2 growth expected to be solid on robust consumer spending and expectations of strengthening exports. So similarly, what had been said before from the Bank of Canada. Okay, so nothing really else from that report there from the Bank of Canada. Okay, so again, just to clarify overall then, let's get the movement here. So the biggest mover today was CAD JPY with about 13.5 pips towards the upside. Then it was GBP CAD with about 27.5 pips down. And then Euro CAD, we'd seen about 21.5 pips down. Dollar CAD, messy trade. had seen about 17 pips towards the downside. So more or less, so we've seen a flash reaction on the dollar CAD with the release itself, but compared to the other releases or other currency pairs here, there was more of a sustained reaction in the market in regards to its reversal time. So that took about, so that was peaked. I'm just trying that. Peaked on the first candle, try to hold that. About a couple of minutes later, start to see that reversal come in a minute after the release. See how much it kind of holds up or stays down long before you can see GBP CAD has had a monster amount of pricing in already with the Bank of Canada redecision. I think one thing to consider with the GBP CAD too is that with the Bank of England, they don't really have too much room to hike rates or to be tighter with their monetary policy. Main factors being, of course, with Brexit causing uncertainty for the UK economy and the energy prices as well. Don't forget the energy price cap being raised back in April. As one thing you've got to consider is that if they do raise interest rates, then that will raise the cost of borrowing and make it harder to take out a loan, and for businesses be paying back on more money instead, which in turn for consumers, which would mean that for them, high interest rates could hurt consumer spending. So I think that's one reason why we've seen cable see that a lot of that pricing in already in the markets before the rate decision. For the Canadian dollar against the Japanese yen, remember, they have what we've seen in the past releases with the US releases. The dollar yen had seen quite strong uptick in volatility in movement, and CAD JPY today here showing to be the biggest mover in the markets so far. Actually, one thing I do want to highlight is the Aussie dollar against CAD. It's released there. So yeah, a bit of a nicer. Again, the other markets had a more of a cleaner reaction. It's about 14 pips down. The Aussie dollar. Let's do NZD CAD, and we'll do the Swiss franc too. It's the same. So about 14 pips. 14.5 pips was the downside there on New Zealand CAD or NZD CAD. Look at Swiss franc. Okay, actually that had a nice movement as well, or cleaner movement, let's say, compared to the dollar CAD and Aussie dollar. So the initial candle seeing about 18.5 pips movement towards the upside there on CAD Swiss franc. So if I just dotted down then deviation wise what we had seen. Dollar CAD about 17 down. Okay, and then if we look at it 10 minutes after the release, that's a bit hard. Let me go to a bigger screen. Okay, so from the start of the candle, start of the reaction. Okay, so about 10 minutes later, okay, so we're about 21 pips after 10 minutes. Or 21, or near enough 22 pips. Okay, so dollar CAD looks like a horrible trade if we're thinking about expectations of which way the market's going to move. EuroCAD, about, let's say 21 and a half pips down. And then 10 minutes later, still going down. Minutes. Okay. So it's about 20 pips. It's about 20 pips down after about 10 minutes. KJPY, which had the strongest move. $31.5, 31.5. Okay, then still up by about 14 pips after 10 minutes. Swiss franc there, so it's 18.5. So for the CAD Swiss franc, that's exactly the same movement that we'd seen last time for the initial reaction. Last time it was about 8.5 pips up. It's exactly the same amount, well, near enough the same amount of pips towards the upside. 10 minutes. It's about 15 up. 15.5 up. And GPCAD. $27. After about 10 minutes, it looks to be four, 5. Thirteen and a half. So just bearing in mind, I am just measuring, so from the release, how much is that currency up or down by? So when I'm doing the measurements of 10 minutes after the release, again, just to show you that it's from the start of the release, that's how much the currency is up or down by. Just to make that clear for anyone who's kind of confused as to what I'm doing. Okay, so about 27.5 down. Okay. So interestingly, if I've got this correct, so the New Zealand CAD, NZD CAD, did see stronger. We're seeing a stronger movement towards the downside. I mean, after 10 minutes post release, did see a stronger movement towards the downside than the initial candle itself. So we'd seen about 11.8 pips down, and then after 10 minutes we were down about 27.5 pips. So I just want to make sure I've got that correct. Sure, with the Aussie. It's about. Oops, hold on. Excuse the wrong one. Down. Just double check out. That's why. Nope. Looking at the wrong currency pair. Yeah. Okay. Yeah. Ignore I said it. I was accidentally looking at the New Zealand dollar and NZD USD. Yeah, that should be about, that makes more sense. Okay, so it's about 18 pips down post release. Ignore what I said just before then. Yeah, there we go. Okay. All right. That is the release there. Thank you very much for jumping on if you're watching. Don't forget to go through those links that I've put out for you. So 7-day free trial of Financials Pro, a 7-day free trial of Tsx, and also the mailing list sign up for the service as well for macro ace to be able to get the week ahead what to expect. So one thing I have changed in the way I do the emails is that at the end of the week, I'll share all the video links for you from YouTube in one email rather than doing an email per day after the release. But do let me know if you actually prefer having the one video each day, or whenever the release happens on that day you would get the video rather than at the end of the week. It'd be good to know what you prefer, but I think it's just easier to have 2 emails a week. One of the previous market reactions that we've seen from the releases during the week, and then one for the week ahead as well. But like I said, do let me know. So tony@financialjuice.com, which I'll put in the chat for you, is where you can email me with any suggestions that they do have. Okay, that's that for you. All right, thank you very much, and I will see you tomorrow for EIA inventories. The release itself is at 11 a.m. Eastern time, so we'll be here at 10:30 a.m. Eastern time. And then Friday, we have non-farm payrolls, so we'll be starting that at 7:45 a.m. Eastern time. All right, take care and goodbye.